Millennials and their parents often have very different styles, challenges, and opportunities when it comes to investing. Our guests today are Brennan Beavis and Marc Beavis. Brennan's YouTube channel, Brennan Beavis Investing, with over 157,000 subscribers, helps Canadians learn how to invest in the stock market with a particular focus on long-term investing. In this webinar, the father and son investing duo will share best practices they've learned from one another that they believe can help new investors set their foot and find their footing in the stock market. So with that, I'll give a warm welcome to my guests, Brennan and Marc. So how is it going, Marc and Brennan?
I'm happy to be here. I know Brandon did this last year, and this year I was invited to join him, and just thrilled to be here. Looking forward to the presentation. Brandon, what are your thoughts?
Just excited as well. It's even a little more special with you here to join this year, Dad. But last year was an awesome time, and I'm excited to cover today's topic. I think it's going to be a really fun one.
I think so too.
Awesome. Yeah. So Brennan, why don't you start by telling us or telling those who don't know you very well a little bit about what you do and how you got started with investing?
Yeah, well, you kind of summarized it at the top there. We did start a YouTube channel. I started a YouTube channel about 3 years back. I had worked for my dad in the industry for a few years. By the age of 20, I went out and got my licensing. I actually became a certified investment advisor, which was a little bit different. You don't really have too many young people doing that. So I tried to kind of mesh my knowledge up with my passion for creating videos. And we started the YouTube channel. And since then, it's just kind of taken off. We're now one of the major players. We're one of the leaders in the Canadian space. And we also have behind the scenes what we call our Investing Academy. This is where some people through the YouTube channel decide to learn further from us. We offer training and just work with some of the students, pretty much every province across Canada at this point.
Excellent. And Brennan, I know not so long ago, you've added your dad, Marc, to your YouTube channel. So about 6 months ago, I believe. So I'm guessing dad probably had a huge impact on your life and perhaps on investing. So now, why having someone bounce ideas off and share experiences you think is important to becoming a smart investor?
It's very important because, my dad was my mentor. And when it comes to what I've learned and the experience that I've gained, I have to just thank him a million times because without him, I don't know where I would be in all areas of life, but especially investing and especially in the stock market. There's some things that you have to learn from experience. You can read the textbooks, you can study all you want, but the experience from being in the markets for decades and decades, you don't just get that overnight. So it's very important to be able to bounce ideas back and forth. I put a lot of trust in my father in terms of the information he passes off to me because I know it's coming from the right place. I know he's got, like I said, the experience to share in that aspect. So I think it's huge. And when he joined the channel 6 months back, the viewers couldn't be more happy. I couldn't be more happy. I think it's just an amazing thing that was able to happen.
Exactly. And learning from each other as well. Now, speaking of your career and your success now, Marc, and I'm sure there are probably things you wish you had done differently. So looking back, what is sort of the first lesson that you have learned when it comes to investing? And I'll get Brennan to share his in a moment.
Well, one of the things that I think everybody at my age looks back and wishes you had done earlier is just flat out start earlier and take it seriously. And I was kind of fortunate as well. My father was in the investment industry, and so at a very young age, I started investing, but really didn't have a plan, and it was kind of ad hoc. And so I wish that I had understood what I know now much earlier in life, and I feel blessed because with Brandon and his younger brother, I was able to instill some of the things I wish I had known when I was much younger onto them. So that's probably the biggest thing. And just mainly just having that plan, having a vision from an early start really pays dividends down the road. Going back to the whole idea of having the plan is it's so common that when you're starting out as an investor, you're just buying almost everything that you read about. You hear about, hot stocks and not understanding how to actually construct a portfolio. And you end up with, you just can't keep up. You think you're diversifying, but you lose track of the investments that you have. You can't properly manage them just because there's so much to look after. And so it's just basically you're duplicating a lot of things and not really having that proper vision. So the biggest thing I would learn is just be careful and don't buy too many stocks just because you're reading about them, somewhere, or hearing them from your neighbor.
If I'm let us say, a new investor, how can they figure out how many positions they should be holding in their portfolio? Or, for example, when to add, how to add positions to their portfolio?
Well, one of the issues that you have to figure out when you're trying to determine, to your question, how many positions should I have? A few different things I would say. First of all, what is your level of knowledge? And for a younger investor, it takes time to build that up. How much time do you want to spend managing your portfolio? It seems like it should be easy, but really, if you're going to manage your money properly, you do have to, put a considerable amount of time into it. So you really have to assess your own situation, know what your capabilities are. And if, there's options out there today. And if you're a person, for example, who likes ETFs and you want to sort of hand off most of the management to other people, well, there's nothing wrong with that. Some people just like to keep it simple and not dive too deep themselves. So there's different routes that you can take. Just understand what your capabilities are is really a key to doing it successfully.
Yeah. And what would you say with maybe investors who already have positions in their portfolio? What if they see a great opportunity? What would you do then?
Well, one of the things when I was working in the industry, I saw from not only young clients, but also from older investors as well, is not having that strategy. And so when you hear about something, the first thing what we do is we create what's called an investment policy statement, or an IPS. And in that statement, you outline what your plans are. It's like a blueprint when you're building a house. You don't just start nailing boards together. You have that plan. That way, if a stock comes along or a tip that you hear about, you can see, well, does that fit into my plans? You don't just go out and buy it. And if it doesn't fit into your plans, you don't have to buy everything you hear about. And obviously, you probably shouldn't buy everything. But without having that vision from the start, you're more susceptible to just rushing out and buying everything that you hear. So creating that plan, having a clear strategy is really, really important.
For sure. And I want to hear from Brendan as well, because I know you and Dad probably have slightly different experiences when it comes to, the first investing lessons. So what would you say about maybe one of the first things that you have learned as an investor?
I think for me, it's actually quite similar to Marc. Being on the YouTube side of things and facing a bunch of people of all different skill levels, it's more common than you'd think that students of our academy or even viewers will basically show their portfolio. And it is insane. Like, you've seen it too, Dad, how many stocks some people hold in their portfolios. I kid you not, there are people that hold upwards of 50 stocks within their portfolio. And we do things like reviews sometimes, and we'll often just take a moment to take a look at what they're doing. And half the time, the owners of these portfolios can't even name what stocks they have in their portfolio, let alone, say what the companies do, have a good thesis as to why they're buying the stock. It's especially hard in the world of social media and the world of, I guess, just all the information out there. There's so much coming at you that it's very easy to go overboard. And I'll tell you, we see that all the time with people don't even know what stocks they have in their portfolio. They have to actually look it up and basically just read out the tickers to us. It's quite crazy because, as you mentioned, it becomes too hard to manage. It's pretty unrealistic, honestly. And the way we view it is that each stock in your portfolio should be part of the overall strategy. Each position should play a role. And if you're just buying ad hoc, if you're buying without any regard for the overall strategy, you're going to find yourself in a pretty messy situation.
So, Marc, thinking about the lessons you have learned along the way and things you wished you had known earlier, what are some of the things that you see, I guess, new investors tend to ignore?
First of all, understanding the depth of your knowledge. That's really key to knowing what you don't know. It's sort of a thing that there's an old saying: you don't know what you don't know, and it's really critical that you don't just start doing things without having a base of knowledge. A lot of investors, not just younger investors, but I think more so today with social media, getting caught up in hype. It's really exciting to become an investor. And even in our the students that we work with, we can just see the excitement when people lay out their plan and then start investing. They get all anxious and excited about making that first trade. Even fear of missing out is a big thing today. That you really want to make sure that you understand the psychological aspects of investing. And so a lesson I would learn is be patient, take your time. There's always opportunities that will come your way. And it kind of goes back to having that plan and understanding what path you're on and doing your best to stay on the path.
And what should investors understand about the risks of investing in those companies? What would you say about that?
Well, always important when you're investing, you have to understand this relationship between risk and reward. And I know it's easy to say, and we hear it all the time. And what I'll hear younger investors say a lot is, I want to take a lot of risk because there's a potential reward. With that reward or with that risk also comes an equivalent amount of downside. And we've always advocated have some allocation in your portfolio if you have your nature is to be a little riskier. But the analogy we use often is having that snowball. You start with a little ball of snow, and as you roll it down, it keeps getting bigger and bigger as it goes down the hill. If you are a younger investor and you have a small snowball to start with, it's really important that you don't shrink that too much, because then you're setting yourself back. It's kind of like drilling for oil. When you're taking on too much risk, and there are potentials, but you're going to come up with a lot of dry wells as well. And so make sure that you're calculating, understand what percentage of your portfolio you're willing to put at risk. And it doesn't matter how exciting the opportunities are, just don't go beyond that. Stick within your risk level.
Excellent. And I love the fact that you brought up, the feeling of FOMO. And I think a lot of new investors get in that feeling and feeling, very excited even before getting into the investment. So for sure, do your due diligence and making sure you understand the risks and reward associated with that, for sure. Mm-hmm. So what would you say, some of the indicators of potentially healthy stocks that you have seen? What are they actually, what should you be looking for?
Right. That's always a tough one, because this is part of due diligence, and some of due diligence isn't particularly exciting, but some of the things you want to look for if you're looking at investing in a company, I always look at, this risk reward. I always look at the downside. And one of the things a lot of investors they ignore is, for example, the debt of a company. And people will often hear a good idea and they'll, go out and buy stock without realizing that, for example, in 6 months, there's a big debt payment coming due. And if the company can't go out and raise more money, that's going to possibly put them out of business in a worst case scenario. You want to really make sure that you understand the cash flow that a company has. And you can get this from a variety of different sources, but you do have to take the time to do that. I would also say, look at the leadership team. You look at some of the best companies in the world today came about because their founders often were the leaders. And even if the founders are no longer there, they've usually put a good group of people into place. I would say a few other things you have to think about is what market is the company in? If it's a strong, growing market and you can see potential going down the road, how unique is the company? Are you like a leader in the space? And I can think of companies where they've basically created a new space, and those are some of the key things I would think you have to consider when you're looking at that.
And I would say it, and I 100% agree, the fact that you have to not only look at the quantitative side, which is the actual numbers, but you also have to, sort of look at the qualitative. Are the maybe the management, are they taking charge of their company? Are they being responsible for what they do? So that's for sure important. Now, Brennan, I know that you share a lot of stories on YouTube, about when it comes to investing at an early age. Do you mind going into an example of maybe at an early age, is there any particular investment or maybe a time that you remember that you had made a certain investment choice that really stand out?
Yeah, no, there's a number of them that I could probably pinpoint, but it's funny what you're talking about there, Dad. All of the right things to do, looking at management, looking at the earnings growth, looking at cash flow. I can go back to when I bought an IPO for the first time. And an IPO, obviously, was very exciting for me. It was the first and actually only IPO that I ever bought. So this is unfortunately a bit of a sad story, how it played out. But again, this was way back. This was much further. And I'm happy to talk about the mistakes because everybody makes them. Everybody falls victim to the FOMO and excitement. But there was a stock that I purchased with no regard for any of the things that you just previously mentioned. Yeah. The only thing that I looked at was the fact that this company was growing their revenues and it was going to be a hot, exciting growth company. I didn't take a look at the earnings. In fact, this company wasn't making any earnings. And to this day, they're still struggling to make earnings, as with a lot of companies in that early phase of their business. But it was a company that I liked. I used their product. I had somewhat of a bias in that sense. I purchased the stock right off the IPO, and I believe the stock over the coming months and years dropped about 80%. So thankfully for me, it was a small position, and it wasn't a big hit to my net worth and to my financial situation. But what it was a great learning experience. And it was something that I will take with me going forward, that's not a very valid way to invest by just looking at even something like revenue growth. As a younger investor, it's very tempting to say, I want the hottest growth stocks and that's all that matters. But that's so far from true, because at the end of the day, you're buying a business for the earnings they can output. Maybe it's down the road that you're going to get that cash flow and earnings, but you are taking that risk. As you said, Dad, there's that risk and reward trade-off that you have to factor in. And just as a little personal story, we made a pact. Dad, you knew I bought that stock.
I know,
and it was something
what
that
you're talking about.
You know exactly the one. And at the time, I mean, you kind of said, it's probably not what I would do, but I said, you don't know what you're talking about. I'm going to do it. Anywho, I made a pact with you, Dad, that I would hold that stock going forward, no matter how it does. If it goes bankrupt, if it goes to $100, $1,000 per share, it's a stock that I will hold in my portfolio so that every time I look at my accounts, it'll be a reminder saying, that's not the way to invest. We actually want to look at the fundamentals. We want to do our quant. We want to do basically the whole picture, making sure that we're picking a good stock to own for the future.
What would you say the metrics that they should be looking for when it comes to things like this? Anything to sort of sum it up?
Well, I'll just interject. Sorry, Brad. I'll just throw in. I like to look. We talked about track record. It doesn't have to be a 50-year track record, but I like to look at a minimum of 3 years, and I look at revenue growth, like you did in that case, Brandon. But then, as you alluded to, there's revenue, and then there's earnings, right? And they're very, very different things. And so I look for accelerating earnings in addition to just revenue, and tie it right back to. If it's a newer company, obviously, if it's coming out publicly traded for the first time, it's quite often a new company with no publicly available information. Then you can lean back a little bit on the management team and see if they've had success in the past as well.
Yeah, to add to that, I think a mistake that a lot of people make as well is when there is that FOMO in the air and everyone's excited, they feel like they have to be the first ones onto this boat. You're going to miss out on the opportunity and you're not going to make a good return if you're, not one of the first ones into the stock. And like you said, if you are jumping into a stock in that position, in many cases, you simply can't find that. If they're a new publicly traded company, that information is just not out there. So how can you make a proper decision without that even being available to you? So like you said, we do like to look back for at least a few years of earnings, a few years of history, in particular, looking for companies that we like to see positive earnings and growing. And by default, that will actually cut off a big area of the market. There's a lot of stocks that we just won't ever touch. But, you take a look at some of the most successful companies today, the biggest companies in the world, investors still make phenomenal returns on them without being the earliest of adopters. You can wait and see some success, make sure it's a great company. And I think overall, as a summary, Ivy, as you mentioned, is just, I think the focus should be more on identifying a great business that is in a good financial position that you'd be comfortable holding for the long term. And that's really where the priority should be put. When
it comes to investing, there are many things to consider. I don't know, from what I'm hearing, Marc and Brennan. Now, it seems crucial to always have to do your due diligence and do your research, regardless of, what the analysts or what the other professionals would have to say. So, Marc, what should investors look for when conducting their due diligence? Are there anything specific that they should be looking at?
That is a great question, and it is so timely because we, I've never in my investment career seen access to information the way it is today. And in the old days, you just relied on your stockbroker to do the due diligence because there's very few sources. Now we've gone 180 degrees from that, and now there's so much information. A couple of things I think are really important to focus on. Find some reliable sources. I know it's easy to say. It's harder to differentiate who's reliable and who isn't. But it's really important that you understand hype versus news. And so it's so difficult to weed through. And since I've been involved in the YouTube community here, I've started watching other YouTube channels, and I'm dismayed at how much not different opinions, but just how much misinformation there is out there. And so really be careful. And I feel for people who are just trying to learn and trying to decipher. But once you find sources that are reliable, narrow down the focus. You don't have to watch 30 different YouTube videos or read 30 annual reports to pick a company that you want to invest in. So that's one thing. I would also say, really, probably one of the most important things when you're doing your due diligence is look for contrary opinions. There's this thing called confirmation bias. And if you want to buy a company, you can go online and you can find a lot of information that supports buying that company. But always, I don't think we ever buy a company without looking at what are the naysayers saying. And we can filter that through and disregard it if we don't happen to believe in it, or the evidence still weighs towards buying a company. But that's one of the things that people do a lot in life, but also especially in investing, is you ignore the other side of the argument. And really important to factor that in. Don't just look for stuff that confirms what you want to do in the first place. Those are kind of some of the main things I would think.
Right. And what would you say some warning signs like new investors should really be watching for, and potentially maybe some common mistakes that they are making when conducting their due diligence?
Comes back to doing the research. When you're doing due diligence, there's a lot of companies that there's not, I would call it sort of thin research. There's not a lot of information. It's almost a flip side from having too much information. And over the years, I've been asked from clients to look at, former clients when I was in the business, to look at certain companies that they had heard, oh, maybe should I put this in my portfolio? And when I was doing research on those companies, you couldn't really find anything other than maybe what the company itself was putting out. And I'm always skeptical what the company puts out themselves, because heck, they're promoting themselves, and that's natural. So I would say it's the two things I'd be the thin research. Make sure there is sufficient research, but don't go overboard, and consider the source so that if the company's just promoting themselves, you have to be able to spot that, and don't get too excited just because it's something you want to hear.
And Brennan, back to you. Tell me about a time that you've sort of made the decision, based on when you did your due diligence. Any example of that for yourself?
When I did my due diligence, well, I'm like Marc said, every stock that we look at for the portfolio does go through our due diligence process. And I kid you not, Ivy, like every single day, there are stocks that come my way, whether it's through a comment or a question from a student or someone throws a stock my way. And 90% of the time, it's through that due diligence process that you realize, well, this maybe isn't the best stock at the given moment. And I say at the given moment because it doesn't necessarily mean that it's a poor company, right? It's not that this is a bad stock, but often when people start asking you questions about, is this a stock for me? I heard this on the news. I saw a YouTube video on this. The reason they are exposed to that is because the stock is probably going through a little hype period, and the stock's probably been driven up and did quite well from a share performance level. And it's, more or less where the stock's possibly reaching a peak that the viewers are now getting exposure to it. And they end up, if you do fall into that FOMO hype cycle, again, not to discredit the company as itself, but you may just not be buying at the most opportune time. And I could pinpoint a million different examples of that, but it really does happen every single day. YouTube is, I think, a blessing and a curse, really, because for new investors, it's a great source for getting information. As you said, Dad, you got to be very picky about who you listen to, because YouTube, in and of itself, it drives videos that are getting more views. it promotes hype is what it is. And in investing, that's not often the best strategy. In fact, what we like to do in many cases is look for those underloved stocks, look for the stocks that are out of the spotlight, because again, you just don't have the masses driving up the prices, and you often get a lot better choices when you're not out there buying into the fads and the hypes.
So with different resources of information being available these days, it seems so easy to be drawn to social media hypes when it comes to investment ideas. So what are your thoughts on that, Marc? What are some of the, what are your thoughts on getting sucked in by the hype on social media? Like, how can investors or new investors maybe separate the hype from legit reasons for optimism? How can they separate that feeling?
Well, that is an awesome question, and it kind of piggybacks on what Brandon just said, where the hype tends to follow an event, and so by the time a stock is being hyped, or you're on social media and you're seeing a lot of coverage on a company, you're going to look at a chart, for example, and it will have spiked typically, very, very typically. You don't see a lot of coverage on companies that have had a rough patch, and maybe offering good value. So be aware, if the company is top of the news and it's the hottest topic out there on YouTube channels, it's quite likely, very possibly, going to be trading at a very high valuation. So even if it's a company that you go, wow, I would like to own this, be careful, take your time, because there probably shortly in the future will be a better buying opportunity than you're having now. And sort of repeating, I guess, what I said earlier, is look at the source. And you have to be able to trust the source that's giving you the information. How are these people qualified? Just pick your favorite, most reliable sources, put some trust in them, and then go with that instead of just following and going down rabbit holes. That's really dangerous to do it that way.
And how can investors, because I know just as a new investor, there's always that feeling, like Brendan said, right? That feeling of FOMO. So how can they possibly resist that feeling during, if I was, let's just say, stuck in a hype cycle? Anything I can do?
First of all, just take a breath, and it takes me back very quickly when I was much younger, back when I was, making many more mistakes than I make now. And I was working in an office, and this was back late 1999, early 2000s, when the tech, bubble was just being created. It was so exciting to be an investor. And we actually implemented a rule in our office that every time you checked the price of your shares, you had to do 10 push-ups, because people were literally, hitting refresh. And so, we realized as a group, so take your time. I've learned over the years, there will always be another opportunity. The opportunities are coming all the time. There's no rush to get in. And yeah, you will let some opportunities pass. One of the greatest investors of all time, Warren Buffett, looks back at errors of omission and said, in hindsight, I would have bought that company, but at the time that you're doing your homework, you just don't have that comfort level. Not a problem. The next day, the next week, the next month, there will be a new opportunity that comes along. And then right back to where we started in this whole discussion is know what your plan is. It doesn't matter what's happening around. When you're, if you built the blueprint for your house and you're putting, carpet in, and some guy comes by with the greatest tile, well, you're not going to switch to tile at the last minute, because that carpet is what you want. They're same thing with stocks. Have that plan and just stick to it. Those are some of the key things that you can do to avoid getting caught up in this.
Yeah, and I would say probably, and I'm guessing for Brennan, at the forefront of YouTube, hearing your students constantly telling you about, the different stocks to potentially maybe asking you for opinions. Is there any time that you felt FOMO on, let's just say, a particular investment, and what did you do in that case, or in that moment, I guess?
Yeah, I think every single person will feel it. If you don't feel the FOMO, maybe you're not human. I don't know. It's natural. It's normal. So yeah, I've definitely been there. And I think what's most important is, like I said, just understanding that that's normal. And rather than acting on it and letting your emotions get the better of you, just make that assessment saying, I'm feeling such and such a way now. And especially if you've been burned in the past, like, myself, there have been cases, Ivy, where, and it's funny you say that, Dad, about refreshing your quotes, every few seconds. And that was back in the day, but the exact same thing happened to me with a specific commodity that I was looking at. I just felt the need to rush in, and it was truly, there's no better way of saying it than FOMO and being pressed for time. And I remember calculating how many dollars I needed and how many shares I could buy. It was frantic because I just wanted to get in. And of course, very similar to my other story, you end up buying at the peaks. It's a very sour experience going from there. And for me, at least personally, when you go through those mistakes, you learn from them. And the next time that I do feel a period of FOMO or I do see a hot stock that's going there, I just think back to that exact experience that didn't turn out well. And I'm able to just recollect and just call kind of what happened. So as you said, Dad, you are going to miss out on some opportunities. And in all honesty, maybe it's a mistake that some investors have to make when they're starting out. Mm-hmm. Obviously we want to give as much information and share our experience as possible, but nothing teaches you more than just making those mistakes yourself. So what I would say is try to minimize those mistakes when you're new and just expect that, hey, I may experiment here, some things may happen and I may lose a little bit of money. But for me personally, it's living through those periods of FOMO and the result of it that now lead me to a point where I don't even bother with those types of companies anymore. I don't want to get into those spaces because it just, at least from my experience, it ends up pretty sour most of the time.
Well, and I'll just quickly add, Brandon, even though I'm almost 60 years old, like you said, we're humans, right? So that fear of missing out doesn't go away. It's probably more acute with a newer advisor. And so even though I guess the difference is you feel it, but you learn maybe sometimes you just don't act on that feeling and things will be okay at the end of the day.
Yeah, you're making more of a rational decision the more that you learn about yourself and I guess about the markets. So in that case, Brennan, where do you normally go for research these days? Given that you're already on social media, so what would you say about the places that new investors can go for ideas or to get ideas? Any trusted resource they can rely on?
Good question. So I think you could break that down into maybe two different areas. You could have your sources of information in terms of, hey, what are some good ideas? YouTube would be great for this, where you do hear a lot of different ideas and you kind of are getting exposure to certain areas. The news, articles that you read online, there's a million sources that will just come your way about ideas. But then you have to have your, more or less back end, deeper dive research platforms. And there are a number of options out there. We use platforms like Morningstar, Yahoo Finance is another great one where you can actually get into the numbers. Brokerages such as TD Direct, you go in through your back end system and you have a ton of information that you need on stocks that you now want to dig into deeper. So I think it's good to use both. In the sense of, hey, what are some ideas? What may work? Then you go through your due diligence process and then essentially weed out the ones that you don't want, identify any red flags, and kind of make your way through that process. But those are a few that I named that I personally like to use. Of course, YouTube. I love YouTube. It's what I do. So it's I gotta say, YouTube. It's a great place. So, but yeah.
Awesome. Well, thanks so much, Marc and Brennan, for sharing those stories and insights. Any final takeaways for, I guess, millennial investors starting out today?
I'll just throw it. I think, well, I love this concept. I love this space of investing. For more than half my life, I've been an investor, and I'm so thrilled that so many people in the last short while have become interested in investing. But investing isn't just you don't just click a button on your computer and make a whole bunch of money. You do actually have to pay attention to it. So I just think it's great that there is the ability to be an investor today is so easy, almost too easy in some cases. Right from the get-go, just know what path you want to go down and figure that out, and then go down it and just resist the temptation to stray off the path. But it's an exciting time to be an investor right now. So I'm thrilled that so many people are going that route. Just do it carefully. That would be my final comments.
What about you, Brennan? What are some of the things that you say would be important?
I would just mirror that, and especially for a millennial investor, I understand exactly what they're going through, and it is exciting. Very tempting to go for those higher risk strategies and, maybe trade the penny stocks or get into the Forex areas. And, my wisdom that I can share is that if you need to experiment and try, do so early so that you can at least get a feel for it. But you look back at people that have generated tons of wealth. The richest people in the world, the Warren Buffetts, the Charlie Mungers, they've done it doing a very boring and consistent thing decade after decade after decade. Mm-hmm. So even if you are young and you're naturally drawn into more of those flashy strategies, like I said, you can try it out or maybe allocate a portion of your wealth to trying those. But in general, just understand how the power of compounding can work for you. And that often just kind of brings me back to more of a level ground, saying this doesn't have to be super exciting. This doesn't have to be super flashy. But I know if I do the right thing, if I set a good strategy up front, if I stay committed and disciplined to my plan, I'm going to do really, really well over the years. Especially for a millennial, you just got to get started. You just got to do it. And you just got to execute on investing, really is what it is, following a plan.
Excellent. And I think one of the things that millennials investors have, and actually include myself, is the time factor, right? You always have time on your side. So for sure, that'd be great. That concludes the first part of our webinar, but I'm sure our audience would love to learn more from you both and listen to what you would have to say. So for those who are not able to stay for the live Q&A, be sure to check out Brendan Beavis Investing on YouTube, where you'll find excellent educational content on long-term investing. And for those in the live session, we're now on to question and answer with Marc and Brendan.